So last time you were on, the title of the show was "It Can't Really Get Any Worse."
Yeah.
Good call, Eric.
Well,
was that October?
No. It was June. It did get worse.
It got a little bit worse.
I mean,
It got a little better, and then it got a lot worse.
We had a sick,
No, but June 22?
we had a sick rally, and then it
Yeah.
got a lot worse.
Right. Yeah.
Did you guys see? Did you see the photos of the trial of SBF?
My assertion.
Did you see
It
this?
was amazing. Yeah, the renderings.
I like the one of Caroline.
So Parikh Patel tweeted the Tinder bio versus real life. I would say that Sam and Carolyn are about equal in terms of their attractiveness. Right? They're both nerdy looking, not super
I have no comment on that.
attractive people. What? I can't call Sam and Carolyn not attractive people.
I think you can call Sam unattractive. I don't think you're allowed to say
I said
that
they're-
she's not attractive.
I said, come on.
she's stunning and brave.
They're,
And I will not have you.
Not in this artist
I
rendering.
said they are of equal
No,
attractiveness.
in the artist rendering, she looks like Gollum.
So anyway, my point is, look what they did to Sam. They made him look like fucking Rob Lowe,
horrible.
and they made her look like a
He looks,
monster.
Eric, Mike won't get this reference. Hold that back up.
Yeah.
Doesn't he look like the animated guy in the Aha video for Take On Me?
No, he looks
Well,
like.
Can we
I
play
don't-
a little
can
bit
we-
more
Can
muscular.
we play that?
I don't know who
I
that
we
is.
can't.
He looks like fake. He looks like fake Rob Lowe from Saved by the Bell.
John, put up Take On Me. We can't. I know we can't play this song.
You remember
Just
that
put-
guy who worked at the what was the diner? What was the diner Saved by the Bell? The it was called the
The diner, not the Peach Pit. That's 90210.
That's
No.
90210.
in
Oh, what diner they go to?
the God dang
That's gonna
it,
drive me crazy.
the diner Saved by
It's like a guy's name. It's like Mel's or Ricky's.
the Max.
The Max.
Max.
All right, close.
So remember the head of the Max that was like Kelly's boyfriend, Jeff.
no, dude.
You lost me.
Anybody-
Are you
You
doing
lost
deep
me.
cuts? Saved by the Bell characters?
It's not a deep cut.
It's a very deep cut.
Well,
Kelly's
anyway.
boyfriend, the manager of the diner from Saved by the Bell, is a deep, deep, deep cut.
Next thing you know, he's gonna look like Screech.
Oh, is Screech dead?
Maybe.
What? That's horrible.
Well, Screech did some really bad
thought
shit.
it was
No,
just a rumor.
I know he was
You
a
remember
mess.
this guy?
Dude,
Oh,
really?
yeah.
You remember that?
Of course. What do you mean? Remember that?
How recently have you been watching Saved by the Bell?
Anyway, is Screech dead? I think so. Dustin Diamond.
No, I know he turned out not to be great, but I also think when you're a child star, and not just a child star, but your whole reputation is look how weird and ugly this guy
Yeah,
is.
it's tough. He was only
Like
44.
you're not going to grow up good.
He
right?
died during the pandemic from cancer. Yikes. All right.
It's not. It's bad. It's bad. But he was young, he died young. It's not good.
So-
SBF. So here's my. We're not doing SBF as, later. We're not going to spend any time on this or crypto in general. But like the end result after reading all his testimony, and the end result is like very mundane. There's nothing exciting or interesting about this. It's just another like Ivy League prick who thinks the rules don't apply to him. Like that's really what it came down. He was probably like vaguely aware that they were breaking the law, but it's like whatever, we'll figure it out. He was just like another entitled, like, oh, don't worry, everything will be fine. I'm Sam Bankman-Fried. That's how his answers read to me. I don't know. Do you have a different take from whatever you saw or read?
No, I don't know about the Ivy League part. I don't think that Ivy League people think rules don't
No,
apply
it's
to
like
them.
not that's a generalization, but I just felt like he had this sense of superiority, almost as if what we're doing, the rules don't even apply, and don't worry.
I think he lives in another orbit.
That's so. I think he's that disconnected where it's almost like, wait, what do you mean we can't do this? I'm going to do it. Like I've met people that have that mentality. Unfortunately, many of them are very successful.
It's part sociopathy, and
There's a little bit fake it till you make it, which is celebrated in modern culture. And then like, didn't Bloomberg TV have a show, Rule Breakers? That was like
Sounds familiar.
Rule Breakers. Like, sounds cool when we're talking about tech. Not as cool when we're talking about finance.
I think the amazing thing about him, and it came out in the trial, was just how he cultivated that persona that the media went apeshit for.
Yeah.
They just loved it, and it wasn't
right time.
It wasn't just him showing up with the afro and the cargo pants, cargo shorts, and sitting on the beanbag, but he actually put the thought and care.
Oh, it was all very
into
calculated.
Figuring it out.
It was very calculated.
and he was right.
I wrote
Do you remember
one-
how crazy people were for him?
I
They just
wrote
thought-
one blog post referencing him. I did a search. Did I ever talk about Sam? I said he was like Warren Buffett of crypto, because that's what everyone else said. It's like, oh, he's like rescuing all these companies. It reminds me of Warren Buffett. Like it was all extremely calculated.
He was called the JP Morgan of crypto when he
Is that,
was
that's what they call
buying
him?
all.
All right, whatever.
What I loved, my
The
favorite.
Warren Buffett of crypto. Of course, he's in jail. the Warren Buffett of crypto should have the longest sentence. That's how you know he's the Warren Buffett, right?
Yeah.
Like that's how crypto logic. So he's not impressive though. When they were asking him questions, the prosecutors, he's extremely unimpressive.
Well, the judges like answered the
his
question.
answers are shit.
Yeah.
Like his answers, he's had 6 months to sit and think about. They had to have known what the questions would be.
Right.
This is not that complicated. His answers were rambling, like almost like circular logic and tangents. It's like, dude, did you just wake up and figure out that you had a trial today? He's extremely unimpressive.
No, he's been at mom and dad's house for like.
No,
what's
he's
it
been in the Brooklyn Detention Center. He's not been or Manhattan, wherever he is. He's in New York in jail.
Right.
He had the deal where he gets to
with
stay
no
in his
internet.
mom's house.
With no internet.
Yeah,
was part of it.
he started sending confidential stuff to reporters.
Right.
And about witnesses.
Right.
Another schmuck move.
Yeah.
What do you think they're gonna? I don't know legal like how these things work. I think they're gonna sentence him to 10 and they'll do 7.
I have no idea. I mean, he will pay. He'll be the face. He'll be the Martha Stewart.
He's gonna
for
pay.
Crypto bad actors,
Yeah.
and he'll be the poster child.
I feel like prison is ripe for disruption. There's got to be like prison on the blockchain or something.
He's gonna get out. Shkreli's out. Shkreli's doing content.
Yeah.
Like you think like Sam?
Not the same crime.
He was he's been a big commentator in demand on SBF.
Oh, he's killing it right now. Martin is so hot right now. So Sam will get out and Sam will raise a fund.
No, he won't.
What do you mean? Of course he will.
No, he won't.
Why wouldn't he?
Who are those other crypto guys?
He won't
that,
launch
like,
he won't launch an exchange. He'll raise like a venture
The
fund.
three
Three
hours guys
Three
were out
hours. Yeah.
trying to raise money.
Yeah.
I don't
Did
think
they?
they're not. I don't
Did
think
they?
they're not.
Yeah.
Tell me what interest rates are. I'll tell you if SBF can raise a fund. How about that? How about that?
Are we good, John?
How about that?
So why are stocks up so much today?
The WeWork guy raised the money. I mean, it'll be.
He's not the pariah that SBF was.
Nobody's a pariah, is my point. Michael Milken runs a conference that, like, the Prince of Siam comes and speaks at. There's no such thing as a pariah. All that matters is, are you famous or are you not famous? Nobody cares what you're famous for anymore. If it was 5 years ago, it's irrelevant. Are you famous? Have I heard your name before? I have? Great. Let's take a meeting. Jordan Belfort was raising money 2 years ago.
Right.
Literally, there's a movie that grossed $500 million about how many people he stole from. He was literally raising money 2 years ago. So tell me where interest rates are. I'll tell you if SBF can raise a fund or not. Right. And the results will surprise everybody because he will. No problem. No questions asked. No questions asked.
Rest in peace, WeWork, right?
It's
officially gone.
WeWork went bankrupt this week.
Gone,
You
but
should
not
raise
forgotten.
another fund.
No, 3 claps.
You should do it. What show is this? Oh, shit.
Today's show is brought to you by US Benchmark Series. Duncan, did you know that the 3-month bill, that's not a note or a bond, it's a bill, is yielding 5.57%?
Nope.
Remember last year on an episode, many episodes, I'm embarrassed to say, I was like, the 10-year can't go above 3%. I don't think I said it can't, but I probably said it won't. Well, that was wrong. Now here we are. You don't have to go out 10 years to get yield. You can do it in 3-month bills. Now, of course, listeners, our listeners know, but just in case you don't, when yields are quoted, it's annualized. So you're not actually getting 5.5% over a 3-month period, because that would be like, 22% yield, right? Just so you know, you know. But with US Benchmark Series ETFs, you can buy individual parts of the curve. So if you want to target specific parts of the curve, whether it's for a liability that you have or because you're bullish on one part of the curve, you can do that really, really easily. To learn more about U.S. benchmark series, hit that link in the show notes. It's USTreasuryETF.com.
Episode 115, ladies and gentlemen. Welcome to the Compounded
16.
Friends. What is it, 116? All right, start over. Let Eric come back into the room. Episode 116, Compounded Friends. We have a returning champion in the house today. I'm so happy that you're here. Did you miss us?
I did.
All right,
It's been,
you were
but
here-
every time I come here, it's like it feels like the market's slitting its wrist.
You were last here in a dark time.
it was
No,
really
this isn't
dark.
that.
It got worse. It got better and then it got worse.
Well, welcome to this. This is the business we have chosen. All right. Eric is the founder, president, portfolio manager of EMJ Capital, a Toronto-based hedge fund focused on long-short analysis of innovation-driven tech companies. Eric Jackson, welcome to the show.
Thank you.
Thank you so much for coming back. We had a lot of fun last time. We talked about a bunch of your stocks, and we're going to do that again this week. What are we starting with, though?
I just want to start real quick with the market rally before we get into all of Eric's stuff.
Yeah.
We don't have what are your thoughts this week. Next week. Do we have what are your thoughts? Is that technically
No.
what are your thoughts? Okay.
We'll be in Charlotte.
So just to piggyback on the most recent what are your thoughts, we were talking about, Josh and I were talking about like what could be a catalyst for the fourth quarter. And we were saying, not that we were predicting what happened the last 2 days, but like, did we already have the washout, right? Breadth was pretty bad, and people have recency bias. They tend to think that bad breadth means that it will forever be bad breadth, that it can't turn on a dime, which it has over the last 2 days. So we have, I have a chart showing the percentage of S&P 500 stocks declining for 3 consecutive days. And that just hit pretty much washout territory. So 65% of the S&P 500 stocks fell for 3 straight days. And that has coincided with bottoms recently. Another stat showing that we were at the washout, just 10% of stocks were above their 50-day moving average. Also, pretty much washout periods. And then you have that coinciding with the Fed conference yesterday. Pretty much everyone thinks at this point that the hiking cycle is over. You have rates pulled back, and that's all kindling for a furious stock market rally. The S&P is up 2.9% over the last 2 sessions, which would be the strongest 2-day gain since January.
Can I tell you something else we were
Do you
right
know
about?
that? Since January.
Can I tell you something else we were right about, though? We talked about this last week. The worst time to be selling stocks that are down on the year is October.
Yeah. That was
Literally, October 31st was Tuesday. Another shitty day in the market, I think.
To be clear, I'm not saying that we were right on Tuesday, although
No. Wednesday, Thursday, November 1st and 2nd, the market ripped, and look what the best stocks are. Russell 2000 beating the S&P, and every shitty tech stock I ever heard of is up 9%.
But here's what we were right on.
Seriously.
Roku's 30% today.
Because that
Shopify,
selling
20,
pressure
20%.
finally
Yes.
comes off.
Pound
And you
year.
don't see it.
My point was that sentiment and breadth can change on a dime.
Yes.
And it did.
Oh, can I say one thing about that?
Please.
To the untrained person that's citing internals, and they're like, oh, 65% of the S&P is in a bear market. Yeah,
Bye.
idiot. When do you think that reverses from? Exactly when it's that bad. Like that's not a negative stat that you're citing to me. That doesn't necessarily mean it gets worse. It doesn't have to go to 85. Like that is what washouts look like. Yeah, I mean, you must agree.
This year, people think of it's a great year, market's up and all, especially Nasdaq.
I think
but
it's torture chamber.
the
this year.
Mag 7 is
Yeah.
like masked, what a disastrous year it's been for most of these Rokus and smaller tech companies.
Yes.
For sure. And
Yes.
so I think that's another thing that this potential rally has going for it now.
So the 10-year was touching 5% and getting rejected 2 weeks ago and had a pretty big drop for the last 2 days. It's now at 4.67. So doesn't take much to get the stock market rallying.
No, and I think it's a combination of things. I think it's the pullback in that 10-year. I think it's the fact that the sentiment has been so poor. I mean, think about, remember all those IPOs that we got in September? ARM and Instacart.
Yeah, they all failed.
And Klaviyo, and they're way down below.
Yeah,
Way,
yeah.
You know, I think Instacart came out with like touched $40. and
Birkenstock's trading
close
okay.
to $20.
Did you like any? Did you like any of those prior to them coming out? Were you like seriously kicking the tires on any of them or not really?
Klaviyo, I like the most.
What's the symbol for Klaviyo?
Okay.
All right, so here's
KOY.
Birkenstock. Birkenstock, I mean, really rough out of the gate.
Right.
But it's come back pretty nicely.
Yeah.
How's ARM doing?
It's down below. I never liked those IPOs in September, including ARM, because SoftBank sold just a sliver of the equity, just to kind of
and expensive too.
just to test the waters. Let's try to stoke some interest in this, and maybe we'll sell a big chunk later if the thing does well and goes up. Instacart, I think, needed the money. I think that's why they IPO'd, and it's not a normal, Think about like 2021. Like, okay, put aside this,
That's not normal
all the de-SPAC IPOs and all that stuff. But there was like a venture-backed, tech IPO every week, multiple, and there's been nothing.
Big ones too. Snowflake, like really big names.
Right. And
Unity
it's been
Software.
crickets.
There was some really big ones.
Huge.
I think so. Klaviyo was like the they do the tech. They handle the text messaging function for like Fortune 500 companies.
Here's Klaviyo since the IPO. Not great, but not
Probably it's probably a great business. I don't know if it's a great stock.
I think the thing that stood out to me is just like there's just been like, we don't want risk. We don't want IPOs. Like occasionally you'll hear about like Kava IPO'd, and people on TV will sort of try to talk about that as if it's like a tech company and like, okay, the IPO market's back and we're going to see these names. There's just been crickets. I don't think that we're going to have a really normalized tech market until Stripe IPOs.
What do you mean normalized?
Like, I think we're still in. I know you guys were talking with Tom Lee a couple weeks ago, and did I hear this right? Tom said like we're going in the second year of a bull market or
In
something.
this
like
house, Tom Lee is a hero.
I love Tom,
Yeah.
and I hope he's right. And he's
He said we're going into the second year of a bull market starting October, which was the 12-month anniversary of the low.
right.
So
but
to say that in October we're in year two, maybe it's a little bit of a
I think
premature.
XMAG 7 though, like I think this has been we're sort of coming up on for tech. We're coming up on. It's basically been 2.5 years of a bear market, I would say.
Yeah, so tech peaked. So
tech peaked in Feb 2021.
Shit tech peaked in Feb 21.
Well, there's difference. There's shit tech.
And then Fang Tech peaked in November 21. But you're right. It's a really long stretch without new highs for most stocks.
And that perfectly coincides with when we bottomed after the .com. It took 2.5 years.
Is that right?
Like grinding
So bottom
down.
03 or late 02?
So it would have been in 02, but 2.5 years. So it peaked in March 2020, and
you're right.
and peak, and it
Fall
took another
fall of
year
02.
after 9/11.
But
for the market
Microsoft and
to
Apple
bottom.
made new all-time highs over the summer.
Yeah, no,
Google didn't. Amazon has been in a bear market for 3 years.
Yeah, but you say like what's a normalized tech market, like in terms of like a normal kind of risk appetite on market should be able to
Support an
digest
IPO a week, for
new
example.
venture-backed
Yeah, yeah.
IPOs every week.
There's
or
not
every
a lot
other
of appetite for that sort of risk with cash yielding 5%.
So, but eyeball test today. Like, look at your individual stocks today. Like all the tech stocks are like, I'm in like CrowdStrike and like AMD, Nvidia. These stocks are acting like it's that week right after Thanksgiving where they really go. You know what I mean? Like when tech stocks really go bananas.
Well, you know what's going
They're doing
bananas
that
today?
now.
It's the interest rate sensitive stuff. So REITs, like Simon Property is up 3%. SL Green in New York City is up 13%. Utilities are up over 2%. The stuff that is tied directly to interest rates are rallying pretty hard.
Yeah, and you can. It makes sense given Powell's comments this week, right? Like he basically said no mas, to more interest rate hikes. And so if you think like Feb 2021 was sort of,
it's funny. Like I don't break anyone's chops about this like live on the air, but I was on CNBC yesterday after the presser, and people are like, we have commenters coming in. They're like, well, he left the door open for the door's always open. It's his job. What are you talking about? Like that's like saying, oh, the dentist left the door open for maybe doing a root canal on you. Yeah, the door's open. Right. That's what they do. Right. So forget about the door being open. There was no change in the statement from the last time, And there's no evidence from the last time to this time that they need to do more. They have things moving in the right direction. So if they're really data dependent, I think we could be done.
And I think the comment that really got people excited was basically like now there's like an equal risk on both sides to hiking more.
Yeah, the
versus-
equal. So right, the risk is two-sided, is what he said.
Yeah.
That got a lot of play too. Meaning, like we could go too far. We are now acknowledging that it's possible we could go too
And
far.
we don't want to do that.
And the market really liked to hear that.
I saw a data point today about gas prices are down like 35 straight days and under $3 in certain areas of the country.
Yeah.
That's got to help consumer sentiment.
Yeah, that I mean, a certain consumer that's getting buried by gas prices for sure. So, what are we doing next?
Also, one other thing about interest rate sensitive stocks, home builders are up 6% over the last 2 sessions. Now, they had pulled back quite a bit, but they're rallying hard. Do we have Apple after the bell?
Yeah, that's
right.
coming.
right.
You're going to give us a live reaction.
All right, that'll
I'm
be
told?
well. No, but it's not until 4:30, so we might miss that. Let's talk about
We're going to turn that camera directly onto you for the live.
everything hinges on Apple. Okay.
Remember when they used to live blog earnings
Yes,
calls?
yes, they still do. Wall Street Journal does.
Do
it.
they do that?
Yeah, well, they run a live blog.
Used to go on Business Insider, and like
Yes.
see what Joe Wiesenthal.
So right, Joe Weisenthal used to sit there like finger on the trigger. He had to be first. He used to do that for non-farm payrolls.
Right.
But he was great. He was great. And there was a time where that was relevant. What is this chart?
Oh, this is a chart of the 10-year Treasury yield
Put it
yesterday with all the news. So you're right. You were right, Josh. The Treasury funding announcement. I saw Axios had a post on that.
Everybody had a post
Ask
on
Eric
it.
if he's heard about this.
What? Oh, do you have an opinion on the composition of how many of which maturity Treasury bonds they sold this month? Have you heard about this nonsense?
Eric
now?
shaking his head. No, me too.
No,
Like,
well, I just heard about Druckenmiller going after Yellen for
again?
like, not issuing more long term.
So he probably has a point there. Like every company in the world pushed out their maturities. What the hell are we doing
Right.
at the government level? Right. If we know we have these liabilities,
No, well, we should have done it 2 years ago.
do it. Well, that's my point.
Yeah.
So what are we looking at here?
So
This is
anyway-
the 10-year yield.
The Treasury funding announcement. I don't know what they announced, but whatever. They announced something. Rates fell pretty decently.
They announced 6
Yesterday
more
was a
weeks
busy day.
of winter. They said.
We got JOLTS data, the announcement, Powell's briefing starts, it ends, and it's a 15 basis point drop. I think it was 20 actually on the day,
It's 4.67 today.
which was big drop, big drop.
We were saying it's going to 5.5 last
Oh,
week.
so I was thinking about this just in terms of how quickly everything reacts to everything else. How quickly these stocks are re-rated based on where interest rates are coming and going to. And yet we've been talking about the economy taking a long time for interest rates to really filter its way through. And I get that, but it's been like 18 months. Like, is there really going to be like an interest rate shock, like a credit crunch?
Historically, it happens in the 19th month.
That
They say.
now, I'm not saying that the market is always right and it doesn't miss things, but like, I'm sorry. I feel like that risk of interest rates tightening the economy, like that's not the risk right now. It's something else. I don't know what it is, but it's not that.
There's Rick Santelli had his like moment a month ago when he was on Fast Money. He was talking about 10-year going to double digits, and so
Top.
that's
Wait,
that's
10%.
13, I think is what he said. So obviously, like, we haven't priced something like that in.
No.
And so, there's a room, that would shock me if we get there, especially quickly. But
If rates go to 8%, yeah, sure, all bets are off. Right. Everything I just said. My point is, current interest rates, we've already digested that. We've already proven that the economy can.
You're saying
stomach
enough
it.
time has gone by.
It's over.
I don't know. I'm not with you. I want to be with you, and I understand your point. I'm not with you.
I'm like 65%. Like, I'm not like pounding the table that it's over, but like
a lot of things in finance do appear on the surface to react quickly, and then a lot of things happen really slowly and don't become apparent until the least convenient moment for them to come.
I just feel like what you're saying is I can't disprove that, and it could be true.
No, I know. I can't prove it.
But what you're saying is always true. Like just wait, we haven't seen it yet.
Well, things take longer than you think, and then they happen more suddenly than you think they're going to happen.
Both things can be true, even though they sound paradoxical.
Is that a Hemingway quote? They asked him like, "How'd you go bankrupt?"
Gradually and
He
suddenly.
said, yeah, slowly and then suddenly.
I think like that chart you had up though, like there's like we overanalyze all the time in financials, and we're trying to like put the points on like, well at 359, whatever Treasury funding announcement, and like
point to us where you were bullish and where you were bearish, if you will, sir.
And so at the end of the day, like this could have just been a pullback from 5% because of anticipation of the Powell briefing starting, and it doesn't have anything to do with these funding announcements.
I would have said 24 months ago, if you told me what inflation would be and where interest rates would be, I would say the market's in a 40% drawdown. We're in a recession. Yeah. I think most people would have thought that, and it didn't come to pass.
The NASDAQ's only 20% below its highs. I think 18% or something like that. Now, Russell is like 30% below its highs. But I would have said the same thing. Like if I knew interest rates were
Russell and Nasdaq are worse than S&P. That part I would have gotten right.
And we're going to talk about a lot of the stocks that you play around with.
Oh, so let's jump into this.
All
so Barron's did its big money poll this week, and we could just kind of breeze through this. But I find this to be interesting just because it gives you like a real sense of where consensus is on the big themes that everyone's debating. So 2/3 of the respondents think value investing will outperform growth investing in the next 12 months. About 60% of respondents say small or mid cap stocks will outperform large cap stocks. So Eric, is that wishful thinking because so many of the people responding to that poll will look good if small, mid, value do better than like the biggest growth stocks? Like, is part of this like, here's what I want to happen, therefore this is what I think will happen?
Right.
What do you think?
Are you asking me, do people talk their books? But I would say yes.
Do people confuse a question like what will happen with
what they want to happen?
What would be great for you if it happened? I think they do it all the time.
Absolutely.
100%.
Okay.
And like, I don't know, 10 years ago, I used to do these blog posts on the Forbes,
I remember
shitty outside blogger network.
I was retweeting them. Yeah.
And
the Forbes scam network. I had one of those blogs.
Did you?
Who didn't?
And so at the end of the year, everyone loves to write, what's going to happen in next year, and let's make the predictions. And so I thought, what I'm going to do is I'm going to like call up like some of my best contacts from the finance world, the tech world, and I'm going to ask them for their best predictions for the coming year, and I'm going to aggregate them, put it in this huge post.
So you called Eddie Elfenbein, and then what? and then what happened?
And I would be like, okay, where's the S&P going to end the year?
Yeah.
And
I was in this.
What's the thing that's going to
what's the biggest risk that no one's talking
trend,
about?
like the AI of the next year or something like that. And so everyone would dutifully come back with their predictions. And I did it for like 3 or 4 years, and then I stopped doing it because I started to realize that 80%, and me included in this group, 80% of the time, like the predictions were just recency bias. It was basically just whatever happened in the last 3 months of the year, it's going to continue on for the next 12 months. Yeah. And and occasionally you'd have like some weird kind of out there prediction, but not usually. And so 80% of the predictions were wrong. And I think that's what's happening here in these big money predictions. Like everyone, we aggregate them, it's going to be value now. It was growth, but now growth is out of favor because it's been 2.5 years of a, bear market. And the same thing happened coming into this year. Nobody saw like tech getting off the canvas kind of coming into 2023.
Well, somebody probably did, but that wasn't the consensus.
No,
definitely not.
No.
Here's S&P 5. Majority of big money investors predict bonds will provide a higher return than stocks in the coming 12 months. So that's not an extension of what happened this year, but
you know how often bonds outperform stocks over a 12-month period?
Like almost never.
No,
really bad bear market.
One out of 3 years.
Really?
Yeah. So that's not a very bold call.
Okay. While bonds have become cheaper this year, stocks remain relatively expensive. The S&P trades for 17 times 2024 consensus estimate.
How is that expensive?
It's not expensive compared to 2 years ago.
I wonder what it is like X Mag 7 too. Like, I assume if you back out
lower.
It's lower, but it's not that low. Yeah. John, throw this chart up. How often the S&P beats 5-year treasuries over different time periods?
Oh yeah, I had Nick make this for me. So over 12 months, just rolling 12 months, going back to 1926, it's 67% of the time stocks beat bonds. So
I probably would have guessed that's 1 in 3 12-month periods.
where bonds outperform stocks.
Okay, so not calendar years, but rolling
Now
12-month
I should have had. I didn't have time, but I will adjust this. I do wonder, like, starting level of interest rates. I would imagine matter, right?
Right.
Bonds are more likely to outperform stocks when interest rates are 5% versus 2%. I'm guessing.
Nearly 2/3 of big money respondents expect the 10-year Treasury note to yield at least 4.5% a year from now, versus a recent 4.8%. The yield still might rise a bit more before trending lower. That's a good guess. While noting that it is at or close to levels at which locking in yields for the longer term makes sense. Okay, that's consensus, but also I agree with it. Like that sounds fair.
Right.
What else? What else is interesting in here?
All this was very bland.
95% expect to reap a higher return from stocks than bonds in the next
Reap?
5 years. Yeah, reap.
Well,
Reap.
chart back on. Chart back on. So 95%. Josh, say that one more time.
95% of the money managers surveyed expect to make more money from stocks than bonds in the next 5 years. What's the historical probability?
Okay, so 25% of the time that's happened. So 75% of the time, stocks have outperformed 5-year Treasury notes over a.
No, they're saying stocks will do better.
Oh, I'm sorry. You
Yeah,
know,
so they're-
my bad. I misheard.
40% of managers prefer U.S. Treasuries to other fixed income. Yields are at 16-year highs. Another 24% like U.S. investment grade bonds. Okay. Duration risk. An average of 61% of the fixed income exposure of the big money poll people is in short-term securities maturing in less than 3 years. Only 8% is in bonds maturing in more than 10 years. So that's going to change this year.
What's your take on this? I was saying to Josh this morning, I think that the $1 trillion that went into money market funds, where it took way too long, right? People still weren't moving when cash went to 2% and 3%, and then slowly at 4%, a little bit more, and then at 5%, there was like a gush of money, like saying, "Holy shit, I got to get some yield on this." I think that made sense, and it still makes sense, right? Like you're getting money, you're getting yield on cash, it's great, but how often does successful investing reward like what's comfortable? So I think that a lot of the money that found its way in cash, there will be inertia. There was inertia getting in there. There will be inertia getting out. And I think that the people that are rushing to cash will be poorly served over the next couple of years because they're just going to forget about it. So if and when rates go back down, I think they're just going to be stuck there.
I think people. It's been such a rapid rise in rates that it's taken some time for people to adjust to that, and I think there's unquestionably some who are taking advantage of it. But I think, how many times have you heard this narrative of like, oh well, now I'm getting such a 5% guaranteed return from bonds. Like, why do I really want to take? Or people are going to sort of pass on equities. I just don't think. I mean, I think after this initial adjustment period. Back in the dot-com era, interest rates were sort of comparable to where they are now. The fact is that if someone thinks like, I can get 30% on Roku in one day, like is it sustainable? Is there a rally with legs here? Then nobody's gonna.
They'll chase. And by the way,
I don't know, but
Nasdaq's going to finish this year up 30%. So for everyone in January that was like, I can get 3% on cash. Congratulations. How about 10x?
Right.
But do we agree that the $1 trillion that went into money market funds, that's not going to come out very quickly?
I agree with you. It'll be slow. It'll chase.
Yeah.
They'll buy the Nasdaq 20% higher.
Right.
But it will. Last thing that we're going to do out of this, because this segues nicely into Eric's portfolio. Tech is both the second most loved and the second most hated sector. John, throw this the blue bars up. So which equity sector do you currently like most and which do you like least? Tech is number 2 for both.
Right.
Why is it so polarizing? Why is only tech would ever be in this position? Don't you agree?
Yeah,
By the way, I'm sorry for the listener. They like energy the best and they dislike real estate the most.
Yeah.
Which I understand.
People can't quit tech. Like they can't. They say that they're going to. They say, big money managers say they want value to outperform and all this kind of stuff.
Yeah.
But at the end of the day, it's embedded into all of our lives. It's increasingly like part of, the total market cap of all the stock market is increasingly going to tech. That was another Tom Lee comment that I thought was interesting.
Tech touches every other sector too, in a way that some of these sectors don't touch each other.
Yeah.
Like you can't really say that healthcare has anything to do with energy.
Right.
You could say tech has something to do with both.
Well, because everyone's using it. Everyone's using the cloud. I wonder if you were to buy the least liked sector whenever this poll is published and held it for 6 months.
What do you think was the least like last year?
Ooh, that's a great question. The least, probably real estate.
We could do this next week.
I'm going to guess real estate.
Last year, this time last year, October last year, I bet it was tech. Well, communication services.
You're probably right.
Facebook.
No,
Facebook was in a 70% drawdown, and
Amazon was off 50%.
Amazon's not
I know.
communications. My bet would be to be consumer discretionary, tech, or communications last October. We'll find out.
How do we find this poll? Can somebody find this for us?
Rob will do it. He's got a phone.
Thank you.
All right, Eric, you're a big AI guy, I'm assuming now, machine learning guy. I am.
I've spent a ton of time over the last couple of years, and we didn't talk about this last time I was on.
All right, teach us some shit.
What's in the infancy.
So you think that this is going to disrupt I think it'll disrupt the world in various ways, but specifically the financial industry. What should we be looking for?
I think you can't turn on CNBC without somebody talking about AI.
Sorry,
but it's usually just like.
It's usually
like what's the next stock? I don't just want to own Nvidia. What other AI stock can I?
Arista Networks.
So, but you don't hear folks coming on CNBC and saying, "Here's how AI is going to put me out of a job." In 5 years or 10 years or something.
Everyone
like that.
else. Not
every other industry is going to be revolutionized, and it's going to lead to massive job cuts, except the financial industry. Obviously, I disagree. Okay. I think we all would agree at this table.
Who is most at risk of AI displacing what they do in the financial industry? I feel like it's people you never hear about.
Analysts?
No, I feel like it's like DTC. It's like trade settlement and like operations type jobs first.
Anything admin, anything kind of low, that's easiest to kind of replace with a robot. Obviously, is kind of.
It's not client facing jobs, and it's not creatives. It's stuff that's like repetitive and formulaic.
But don't I agree with Josh, but don't you think that analysts are going to be able to do more with less? Like, don't you think that a PM, if they used to need 3 analysts, they might need 2 or 1?
Yeah, and so inevitably there will be fewer analysts. Therefore, I think because the remaining analysts will be more efficient.
A lot of this is though attrition. It's not that they fire 20% of the analysts; it's that they don't hire the next crop to the same extent that they hired the last generation.
Right.
So it's glacial in reality. This is not like, oh, we have AI? All right, get the out. Go pack your shit. We don't need you anymore. That's rarely how these things go.
Right.
It's a lack of hiring for these positions because they could be done more efficiently.
Well, I heard an amazing stat. You've probably heard of Microsoft Copilot.
Yeah.
It's getting huge play these
days.
So
on GitHub, coders are like freaking out over this.
Right.
Because they basically have the helping hand of AI writing code.
Yeah. And now Microsoft likes it so much, they're like trying to extend Copilot. They are extending Copilot to things like, Windows and Teams meetings. So it does an audio transcript of your team meeting and sends it to you. Or if they mentioned your name at the meeting and you weren't part of the meeting, you get a little alert and all this kind of stuff. But the software coding piece is amazing. And I heard Jeffries predict that by 2025, Copilot was going to account for like $19 billion of Microsoft. That's 10% of Microsoft's revenue. 10%.
How are they selling? Are they selling that as a monthly subscription or usage based?
Yes.
Or okay.
Yeah.
Are you using it?
And so and so basically what I've been working on the last couple of years is hiring software folks, building AI algorithms to try to find relationships between what drives stocks up, what drives stocks down, how does it vary by market cycles and all this kind of stuff. There's so much, and so there's a lot of computer jockeys.
You can't use ChatGPT for that because they won't pull in recent stock market data.
It's interesting. They do use ChatGPT actually for specific programming language.
But just not stock returns.
No, you can't. You can't go to ChatGPT today and say what stock should I buy for the rest of the year?
No, you can't. No. So the point I was trying to make is they're specifically throttling economic data and stock market information. Mm-hmm. I think the latest data they're porting in is September 21.
Yeah,
because they don't want anyone to accuse them of spitting out investment advice.
Right.
No, they don't. They don't want the liability of somebody building something that they could trade on.
Do you think there will be any sustainable alpha here?
Absolutely, 100%. There will be a Chat GPT moment, which was, basically last November was when Chat GPT kind of became, common knowledge for the 14-year-olds.
It's like only a year.
Yeah, but how, before that happened in November, how often did you hear folks talking about big data, AI, neural nets, and then
Very generally.
And
Yeah.
so there wasn't anything you could point to.
Yeah.
And it was years that went on. And to the point where, I'd be like, whatever happened to big data? I remember thinking before ChatGPT, everyone used to talk about big data. Was that a bust? And then all of a sudden you had this moment. So I think there's something similar is coming in the finance world with investments in AI and ML. So obviously that's where I'm putting, my money where my mouth is.
Let me ask you this. I don't know when this started. Maybe 10 years ago when there was like satellite data, right? Mm-hmm. Where people were counting foot traffic going into Walmart.
Counting cars in parking lots.
Yeah. And you tell me, didn't that get not arbitraged out. Any sort of alpha there got competed out more or less immediately? Didn't everybody have that very quickly?
Rob, we could have Rob as a guest on the show. That's what Rob was doing.
Well, 2 years ago, I went to a conference like 2 blocks north of here on 6th Avenue, and it was just data vendors. And there was someone with selling satellite, and you'd go from like table to table.
Battle of the Quants.
And somebody had like, I got pictures of the satellite images of this Tesla Fremont plant, and the cars rolling off the assembly line, so you could count the number of cars.
Or is that a guy with Polaroids?
No, but anyway, my point is, can't that same alpha that's not structural alpha. That's alpha that people find and it gets competed away. Can't the same thing happen whether it's you competing against Citadel and Millennium? Like, isn't everyone going to be doing this?
Yes. And that started to happen. You have like people, there's like Yipit and these firms that basically they track, email to see others who track like, how much money people are spending on eBay or Amazon intra-quarter to try to, and then they publish reports to say, hey, Amazon's going to beat its quarter because it's tracking ahead and all this
AI.
Apps down.
This is just alternative data.
Well, to be successful in AI, you need to feed it with data. And so where I will agree with Michael is that there's a lot of data out there that gets immediately disseminated in the marketplace, and therefore the value is gone. There's other data that just you could blow your brains out spending money on data vendors, and the only people who are going to make money alpha from it are the data vendors, right? And so you have
to think of something that other people aren't buying.
Yeah. But what AI and ML make possible is kind of like it's basically like a bunch. It's highfalutin nonlinear regression, which basically means you're searching for needles in haystacks much more effectively than you ever used to be able to do before. So you might find that the Tesla satellite imagery data, when it's paired with, some other kind of wonky data, actually does lead to an alpha, signal that only you have done the work to kind of put those two things together and build an algorithm yourself, then you can take advantage of it.
Tell us how you're using AI in your fund right now.
So we've done,
give us the equation. I'm kidding.
So
tell us what you're doing.
So we've looked at a bunch of areas like operational data, just all the technical moving average, stochastic indicator, oscillators, and all this kind of stuff. All those kinds of information. We've looked at app downloads, app store downloads. We've looked at Google Trends.
You're looking for signals.
Yes.
So you're combining fundamentals with technicals?
Yeah, and put them all together, put them in a big jug, shake it up, and kind of see what seems to influence what. And there've been a number of kind of interesting findings, like some of those, the standard technical indicators that we would think are like gospel, like, oh, well, when you break down below the 50-day moving average or the 200-day moving average, actually turns out means nothing, in general.
But the AI component of this is that you're feeding it into software, which is doing the work that a human analyst would have done in Excel.
Well,
I'm trying to figure out how this is AI.
It would be hard for a human to even do some of these analyses. Okay. Because you're trying to track all these different variables for all the stocks. I focus on
AI is accelerating.
Yeah,
but is it running the money or is it giving you suggestions?
No, it never runs the money. It gives suggestions.
It's a suggestion
and then the human overlay over it because. we're on version 1 right now in terms of, and it's taken us kind of 2 years to get here. And I'm sure when we get to version 10 a few years from now, we'll look back on version 1 and wasn't it so quaint that we only, focused on these variables? Because by that time we'll have like half a dozen.
It's not going to auto trade for you. Just in the same way that if you had to write a letter, like if Robin's like, Michael, I need your help, write a letter to the PTA, this is what, or whatever. You wouldn't take exactly what GPT spits out. You would take it, pull it into an editable doc, and you would.
Yeah, but there's a ton of money that's being run that way, just algorithmically. So you, and not just you, but a lot of people are on version 1 of whatever this is.
Right.
Renaissance is on version like 20. They've been doing this forever.
Yeah, no, I remember you guys had Greg Zuckerman on here like a few years ago, and he wrote about Renaissance and Jim Simons and stuff, and did that book. And one of the most interesting things about that book is he sort of talks about the early days of Renaissance, and they would send people down to Washington D.C. to go sit in the basement of the Federal Reserve Library, and they'd pull out these like wonky data sources that nobody else was paying attention to, and then that goes to your point about dissemination of this, but they figured out that certain variables mattered most, and then obviously for them they have a very kind of short-term time frame. That's another thing that's sort of fascinating about this is that you say, what does your AI model prove? You can focus on there's so many aspects of the market. Like you could focus on are you focused on hyper minute to minute trading? You want to be in and out within a few minutes.
Specifically, you're using it as a screener to uncover opportunities in individual stocks.
Yeah, so remember I said like the 200-day, the 50-day, we found it didn't work for the universe of like 300 tech stocks around the world. That there was no
signal for
one
stocks.
silver bullet that predicted all stocks, but we would find like certain patterns that really predicted Tesla stock movements, and then other signals that predicted Apple, but only when to get into Apple, not when to get out of Apple.
So certain stocks will behave differently than one another. You can't just use one formula for everything.
Oh, that's interesting.
And so that's where again, like this is what a human can't do is like figure out like and certain patterns might work for Carvana in kind of normal to up markets, but not in a bear market. And so like how can you on the fly?
Do you think there's enough data though for something like Carvana? Like has it been trading long enough that you could trust technical signals on how it trades?
Well, ironically, we spoke about Carvana the last time I was here, and
great trade.
You killed it on that trade,
dude. Like for whatever reason, Carvana has actually been, or it's not unlike Klaviyo. It's like Carvana, I think IPO'd in 16 or 17, so it's got a decent
around.
track record, and again, one of the fascinating things so far on version 1 that we found is that I would say like the top 20% out of the 300 tech stocks that trade around the world, I'd say there's about 60 that the models that we found so far work really, really well with. The rest, the 80%, don't work so well. And Carvana, for example, is one of the
when to get in and out, not about what to buy.
It's about when to get in and out for which stocks at which moments. So we tend to focus on a certain subset of tech stocks that the models work really well for. And Carvana happens to be one that is kind of like this kind of weird stock. A lot of people are really bearish on it, but for whatever reason, the signals that we focus on, it seems to pick it up well.
So there's a great quote from Mandelbrot, the guy that discovered fractals and wrote about them, and he said, "The trend has vanished, killed by its discovery." And I think that markets function that way. They behave more like biology than they're not governed by the laws of physics. So. Somebody else had a quote, like as soon as you figure out the market, they change the lock, or as soon as you think you have the key to the market, they change the lock. So where I'm going with that is, how are you going to know when the signals stop working, and then what?
You'll know from the margin calls. that'll be the thing where you say.
But don't you think that is how markets work? That you can't just figure it out, that they're always changing?
Yeah, but and we've seen that ourselves already. Like even since we've been kind of using the AI models live, over the last few months. Like we start, June, July, a certain stock models trading really, really well, and all of a sudden, like the last 3 months, bit of a herky jerky market to down markets. That same, the company stock that the model no longer seems to work as well.
So when the model's working well, you ride it, and when it breaks down.
You get out, but you improve it as well. And so I think that's where, in version 2, version 3, the Chat GPT moment for how AI is going to impact finance is, I think the models that you build will get better and better about kind of saying, hey, this is, we're coming to the end of the line here in terms of being able to predict Apple, and it's time to stop focusing on that. But hey, some new tech stock, Klaviyo, has now been trading for 3 years. There's enough data that we have on Klaviyo as a public company that we actually think we're starting to trade it really well here with this model. So we're going to swap out Apple, swap in
Klaviyo. Who I feel bad
Klaviyo.
for, there's so many guys, it's almost all guys, that are doing this in a very primitive way, out of their own memory.
Right.
There are guys sitting right now, no offense if this is you, but they're no, but there are guys oh, I always buy Nvidia after the earnings. When they miss earnings, I buy it on the third day after they report.
There's people that
They're
will
doing
trade
this
there's people that will trade a specific stock, and they think because they trade it so often, they know how it behaves.
Those are usually the same guys that
Just
refer to the
intuitively,
stock as
intuitively.
as a she. Be like, she's trading heavy today.
Yeah. Yes.
These were probably the people 100 years ago used to feel the bumps on your head and make predictions about them.
phrenology. Right. No, but there are dudes in their basements.
Well, they're giving the alpha.
They're the ones coughing up the alpha.
So, Eric, how much of these models are price oscillators, whatever you're using for price inputs, versus fundamentals versus alternative data?
You can build a pretty good model on price alone. And as a former,
you're a fundamental guy, right?
As a former fundamental guy, that was sort of shocking to me when we started to kind of see the results.
Oh, so you learned something new as a result of going through this.
Yes, I
okay.
did.
No,
sure.
that's the point.
But
did you think technicals were bullshit growing up?
Yeah, I typically I was and
Not
you
bullshit.
gotta know the company. You gotta know what's been happening and the dynamics and stuff.
The hardcore technicians would say, "Who cares? It's not my problem."
Right.
No, they'd also say whatever you know, everybody else knows, and it's in the price.
But I would say though that we found that the best performing models though there's additional non-technical data added in, and we use neural networks to kind of be able to track these different things. And so,
what do you use it for?
Well,
I just want to compare if you're doing the same thing that I'm doing.
And so when you use those additional variables, suddenly
like what? Fundamentals?
Sometimes fundamentals,
okay.
Sometimes App Store download information.
Oh, okay.
Sometimes Google Trend data that matters for this
Eric,
particular stock.
That makes intuitive sense to me that something like that would work. If you say okay, we want to buy stocks in uptrends, get rid of anything that's not in an uptrend. Okay, want to buy stocks in these 3 sectors because we've done all this testing, and according to the AI, these are the 3 sectors that our signals work the best on. Okay, great. So let's focus on these.
Right.
Now, is there a data source that other technicians aren't using, but that is fundamentally meaningful enough that there could be an upside surprise in the stock? So App Store downloads or the ranking of where that strikes me as the exact type of thing that you should be doing. And then you could say, there's a reason this works, not just theoretically, but in practice. The reason this works is no one else would have thought of this combination.
Right.
Therefore, I'm not fighting against 5 other algo traders who are running the same algo. So that makes intuitive sense to me.
That's my bias. I mean, I'm in my career, I've always been kind of a jack of all trades, sort of master of none, and a lot of people look down on that. You remember, a few years ago, Mark Andreessen and folks from Silicon Valley were saying nobody should get a liberal arts degree. You should only study coding. It doesn't make sense. Yeah. It's a waste of money and all this kind of stuff.
Also, you should put all your money into Bitcoin. And,
But I think that you're onto something. That the most creative people leading these kinds of finance AI projects are the ones that are going to be able to. I got some exposure to technicals. I got some exposure to fundamentals. I know enough to be dangerous.
A little bit of classical literature.
Let's do a little art history. Let's find some data sources.
Peter
that are
Thiel's
kind of
I'll give you $1 million drop out of college.
Right.
Okay, I'll also give you another $250,000. Go shoot your parents. Like, right. So it turns out that learning about something other than investing might help you in investing.
People sometimes ask me like, well, why haven't some of these, I hear about Two Sigma all the time. If AI is so great, why haven't they been more successful and so forth? And I don't know any details about Two Sigma.
Because their households are breaking up.
But I think that if there's no question, there's a lot of quant shops out there that are pure nerds, pure like software programmers who don't know anything about finance involved in building these models. They're kind of left to their own devices, and I think they're missing stuff. There are lots of blind spots that you have with that kind of an approach. And I think the most successful approach over time is going to be, you got to have a combination. You got to have technical people that obviously know what they're doing. You got to be able to communicate with them. When we started, we had some folks in Pakistan working in the middle of the night, couldn't manage them properly. It was a pain in the butt. I didn't know if they were working 3 other jobs at the same time they were working for us and all this kind of stuff. So you have to practically
to revise a colloquialism for what you're saying, like a quant would know statistically that a tomato is a fruit, but then like somebody that maybe learned something else would be able to come along and say, okay, but you don't put tomatoes in a fruit salad.
Yeah.
Right. So it's like that extra layer of I've been around, I know some stuff, and you're missing this. And your math is missing this really important thing.
And so, I think you want to be thinking, and all the finance industry needs to be thinking of like, okay, like what's my team going to look like in 5 years from now? How many programmers am I going to have? How many of my analysts am I going to have? Because I think the numbers are going to change, the ratios of how many you have doing what. I mean, one of the point I was making before about Copilot, one of the programmers who works for me was telling me that he saw a stat recently that said 40% of the code that is produced now by programmers around the world came from Copilot. So think about like how many fewer programmers you need to employ if that's the case. And that's today on version 1 of Copilot.
So
what's that going to be like in 3 years?
That's what Michael was saying. Like it becomes like a supercharger for the talent you have.
Right.
It gives them the wherewithal to do a lot more.
And when I talk to real people, like I'm talking about retail clients, people who put money with me or kind of talk to about putting money in this type of an approach, there's like one thing I hear like more than anything else, which is like, I heard about this AI thing. I've been with this Raymond James advisor for like the last 3 years. Guy's kept me out of the market the whole time. He's giving me bad advice. I can't take it anymore. I just want to trust the computer. Like they don't even understand under the hood like how this stuff works or how it will work, but they intuitively get that a machine could probably be less emotional, less attached to staying in certain trades for too long, who could like pull the ripcord, get out of Apple now, get out of Tesla when it's at $300.
I 90% agree with that. In a bear market, if the machine keeps them invested, even if it's the right thing to do, they're not going to be able to live with just letting this computer make my decisions for me. Like that's where it works against you. But 90% of the time, I agree with you. Like people have seen enough of human nature that they are as comfortable trusting a machine.
Yeah. We still make lots of mistakes, and we'll make lots of mistakes. But I just keep focusing ahead on like 3-5 years from now, like we're going to have that Chat GPT moment. I mean, I think in the financial advisor world,
what do you mean by that?
I think
on Wall Street, you mean?
The Chat GPT moment is that you're going to hear about. It'll probably be some big firms like big hedge funds, whether it's like Point72 or Co2, like having big breakthroughs with their AI, having a shoot the lights out type of year, like triple digit returns, and they credit their AI models that they've been working on. You're going to hear about smaller shops, hopefully EMJ, that had focused returns and good returns in tech space or whatever. I think in the financial advisor world, there's going to be it's going to change that. You're not going to be able to just kind of be friends with your advisors. I think people are going to expect more quant model. They're going to say, "Hey, Josh, Michael, what does your model say at Red Holz Wealth Management?" We went
through that with when the robos came along, and the robos all failed.
Right.
They didn't fail in that the tools aren't useful. They failed to build standalone consumer-facing businesses that could get big enough in time before Vanguard and Schwab showed up. But most of the conventional robo tools today are being used as call center technology so that Merrill Edge, for example, doesn't have to hire 100,000 new advisors right out of college. They could hire 10,000 who would do the work of 100,000. Therefore, they could scale up to billions of dollars. So I think the tools are the tools. Here's where I agree with you, though. There is going to be a story. Somebody's going to come out of nowhere that no one's ever heard of, put up shoot the lights out numbers, and they're going to point to the AI, and they're going to say proprietary this, proprietary that.
Right.
But that's not a new story. I mean, that's what Bridgewater was telling people. It was their models, their proprietary. So it'll just be like a souped up version of like a very old story, which is it's a black box. I'd explain it to you, but you wouldn't understand it. Like Morgan Stanley had algorithmic trading, 25. You probably know more about this than I do, but like there have always been people pointing to their models and saying, you can't replicate my model.
No, there's no question. And one guy invested in me. He said, like we used to have this guy at Goldman. Like he came around and he always his models worked until they didn't.
Yeah.
And then like 2008 came along, and he got blown out of the water, and he was fired by Goldman.
LTCM had models.
Sure, but the difference
isn't new.
The difference is now we did not have like servers and servers.
The arms rate, the power
to power these things. Yeah, so
it's
materially different now in terms of what's available for those who want to like pick up the ball and run with it.
That's true, but competition is competition, and everyone is using the same tools, and the tools today are much more sophisticated. But the competition is.
But the way you implement those tools is like there are a million ways you can use the same tools and get things wrong. There's like tons of mistakes you can make along the way in terms of like. Overfitting your data, which just means that you could you had this big pool of data that you were analyzing, but then you were sort of taking data from the future and mixing it with data from the past.
I guess what I'm saying is there will be people, hopefully you're one of them, that are spectacularly successful using these tools, but the average will still be the average.
I don't disagree with that, but the question is like if there is a ChatGPT moment 3 years from now, and like, oh my God, like XYZ firm or XYZ financial advisor just figured it out and they're doing this. Well, they didn't do it overnight. It's probably been 3-4 years in the making. And so then you're like, we're going to come back on Monday morning, the competitors, and say, okay, guys, what's our strategy? Like,
definitely.
We got to hire some folks, software. Anybody know any coders? Let's get some coders.
There's
around
no
here.
doubt that's going to happen.
And let's just throw it.
I totally agree with that.
Go off in the boardroom and come up with a solution and report back.
I would bet in the last 3 years, Goldman hired more IT people than CFAs.
Right.
So, Eric, what does this mean for companies that you cover? Like, who are going to be the winners? I mean, obviously NVIDIA, but what are some of the others?
NVIDIA's in the driver's seat, and we can talk about them, at some point. Like that's one of my favorite. It's my favorite of the Mag 7 large cap stocks. I think it's still underappreciated.
I think it's trading wonderfully. Look at this 30% gap or 25% gap or whatever it is. Not even getting anywhere near it.
I think what's most interesting about that is that nobody had ever seen anything like that, like a $7 billion.
The guidance
raise
it was
above
7 to 11,
consensus,
right?
Yeah, for the next quarter,
or 11 to 17. It was
They did it
something
twice.
nuts.
They did it twice, and 2 quarters in a row.
Yeah,
and there's this Peter Thiel clip floating around Twitter of the last few days that I saw, where he's talking about how the biggest mistake he ever made was on the Series B investment in Facebook. He was in on the Series A, but he wished he could have done it all. And the biggest mistake was that the metrics for Facebook had improved so much from Series A to Series B, but the valuation did not. It increased, obviously, but it didn't increase as much as it should have, given what the metrics were, and therefore like what that meant about the value of the company. And so his big mistake in hindsight was not recognizing that and going all in. And he said, most people tend to underestimate when there are these big kind of shifts, like just how big it is and what it means to and I think that's happening to NVIDIA. I think like that May raise of consensus is, people are now it raised the whole market for a couple of months.
The stock is cheaper now than it was in January,
yeah,
despite being up 200-something%.
That's wild.
But you still hear people going on saying, well, it's expensive, or it's overplayed.
The price is up a lot.
Somebody at Sequoia said that like there's got to be like $200 billion worth of demand or something crazy for NVIDIA. Like, who are all the buyers of all of these chips?
Well, this is the big thing is that, I heard you talking the other day about this, Josh, about there's two differences or two phases of like building AI apps and then deploying them. There's the training phase, which is basically you messing around in a sandbox saying, hey, maybe these technical indicators work.
NVIDIA
maybe
owns that market.
Right. And then there's the rollout phase or inference phase. And that's when you actually, phase one is like, Eric likes cats. This is what a cat is. Phase two is on Reels. Like, okay, we're going to give Eric like all the cats, videos he's ever wanted, and not give him the same ones, and so he stays on the platform longer. So I think what people are missing now with NVIDIA, and why I think it's super underpriced relative to where it's going over the next few years, is that they're not demand constrained, right? Everybody is, but we're still at this like messing around. The $7 billion raise is a bunch of their customers messing around in the sandbox. And so what happens when they go to rolling this thing out like full big time with the AI apps that actually work? They will need more chips. And I've heard some people say, it depends on the application. In some cases, once you go to rollout phase two, you need 10x the number of H100 NVIDIA chips that you needed in phase.
So the
in-
inferencing chip demand, first of all, you need CPUs for that too. It's going to benefit the whole sector.
Oh, yeah.
The thing about AMD, so I recently bought some AMD, not enough because it went up. If it went down, I would say I own too much. But AMD has not been asleep. They've been quieter because they're not as advanced, but they are thinking about the inferencing market as being their advantage, and they're architecting deliberately for exactly what you're describing. And we won't know if it was successful for a couple of years, but they're launching their chip, the MI300, which is meant to compete head-to-head with the H100 the first week of December. You have thoughts or feelings on the AMD opportunity?
I still think that inertia is going to dictate that whoever you start buying chips from in phase one is who you're going to use in phase two.
What if I tell you Jensen Huang and Lisa Su are third cousins? I swear to God, that's true.
Is that true? I didn't know that.
They're from the same area of Taiwan.
Oh, that doesn't surprise me.
Does that change how you feel at all? Or
I think AMD is going to. I mean, this is going to be a rising tide. People are going to make money. I mean, AWS. If I'm right, and NVIDIA, NVIDIA's opportunity is actually 3-4x what it currently is, and these $7 billion raise is just the beginning.
They say
it's going to raise the tide for AWS.
They say that TAM is 150 billion 5 years from now. Mm-hmm. So if AMD gets 10% of that, that's pretty good. Sure. Relative to where it is stock. If they get 20, it's a grand slam.
Yeah.
But you gotta wait 5 years to find out. But
I would just say, like in any market, it's usually the winner that accrues the best returns. And so, if I'm going to own somebody, like I'd rather just put my chips behind NVIDIA rather than AMD. The other amazing thing about that NVIDIA is like in a good year, a couple of years ago, they were doing like $1 billion in free cash flow. But now, like the world has changed since the $7 billion, consensus raise above consensus, and so. In the next few quarters, they could do $4 billion in free cash flow in a quarter. $7 billion is not out of the realm of possibility next year. That's massive money that they're going to have to spend on.
This is a chart of their free cash
chips.
flow.
Yeah,
I mean,
like their debt's going away with that.
It's unbelievable.
What if the demand doesn't materialize as quickly? So, in other words, what if we're super bullish on AI and the demand for NVIDIA's products, but we have the timing off? And there's a quarter somewhere in the middle that lets people down. I mean, you would agree this is probably the biggest risk to NVIDIA right now.
Yeah, and I think also the biggest risk is the fact that they just can't make enough chips, and so like they need to.
No, stipulated, but we all agree on that.
Yeah,
like we all understand there are literal supply constraints.
Yeah. So
But what if there's So hear me out. During the pandemic, there was double ordering for everything. Right. Like Peloton found out the hard way.
Right.
All right. So everybody was double ordering. The thinking was, well, we better double order because we don't know if we're getting any and when the next shipment is coming. And then supply chains kind of eased, and a lot of these orders were canceled. And that's how you got all of these negative surprises. I'm not saying that's going to happen with NVIDIA. I'm just saying it could. What if there's a lot of double ordering of GPUs right now because Microsoft and Amazon and everyone else is terrified that they're not going to be able to get what they need, and then they do get what they need, and we get order cancellations, and then all of a sudden, NVIDIA gets shocked, and it's not bearish on AI. It's just, oh, this wasn't the real amount of demand that we thought it was.
Right.
Like for me, that's the thing I would worry about. That might never happen, or it might happen this quarter. And I just don't think anyone could know, including NVIDIA, when they give guidance. I don't think they could know. So
I think that I would say, yes, the risk is anybody who's playing in the sandbox now, building, using their chips to kind of build these apps. What if that process takes longer than expected? Or what if not enough new enterprises show up to start messing around the playground sandbox as well?
Because it's an expensive sandbox, Eric. It's not free.
Yeah.
If they
messing around, the cost of compute is a real cost.
They're going to fall 25% if they miss a quarter.
They are, but I
in a day, the first
in a day.
Yeah.
But the fact that we just had this like such a outsized return in May for this like raise of what they have, and they're not going to do that every quarter, obviously. I think that just shows like we're how many we're still very early days in terms of like real companies getting in here. And
I feel like generally speaking, when you think about the fact that we are early days, but the stock is up 100, 200%, whatever it is, I think the early days argument usually wins. Like when something is so hot, it doesn't just die immediately.
Right.
Let's do some tickers. You're buying another AI darling, Groupon.
What the hell?
The co-founder blocked you on Twitter, which is cool. Aren't you too old to be getting blocked on Twitter by people?
He was the first guy who I know of who ever blocked me on Twitter. He's no longer with the company. Andrew Mason. Remember, he was like the bright-eyed, bushy-tailed co-founder when they IPO'd in 2011.
I haven't heard this name in a long time.
I haven't heard this guy's name in a million years. But why do you like the stock, and why did you say that shit about his wife?
Well, there's this stock is I found it with AI. Obviously there's no AI tool.
Oh, okay.
But I actually, to be honest, if you'd asked me, earlier this year, I would have said, like, is it even still a public company?
Yeah, I was going to say, what AI did you use? Chat POS? How did you find? How'd you find Groupon? All right, say more. I'm sorry.
But when
it's a blue chip.
Yeah, I just turned super bearish on AI.
So when this stock, like,
my AI is shorting your AI right now.
This stock is still around. There's still a coupons company, basically, and it's
AI coupons.
Back in May, it was like $100 million market cap company. So it was around as a public company, but it was basically had been forgotten about, sort of circling the drain. And but what I thought was interesting, though, it's kind of an activist play, because basically what happened is, the guys who run it now, it used to be run out of Chicago, and the other co-founder is this guy, Eric Lefkowski. He's no longer involved in the company, but the management team was still in Chicago. And I started reading up on it, and what happened is that there was some guy in the Czech Republic who had built a bunch of web companies over there that I'd never heard of, and sold them and made some money, and knew how to make money from web companies. So he decided that, seeing Groupon trade where it is, like, this thing is an opportunity waiting to happen. But they were wasting money, they're losing money constantly. So he basically buys up 20% of the stock himself and some of his friends from these past
with $100 million market cap.
Yeah,
he threw $20 million in.
Yeah,
okay.
And then he goes to the Groupon board, and like an activist, he says, what are you guys doing? Like, you should be doing this. You should be cutting costs. You should cut all this headcount in Chicago, where it's expensive to have all these people doing these things. And, you should be focusing on international much more than you do. They were like 90% still U.S. focused in terms of their revenues. And there's a big world out there. And this thing, Groupon, it's kind of like Yahoo, where, unlike all these DTC companies you see advertising on CNBC these days, we're trying to like come up with these crazy terms and stuff. Everybody knows Groupon, everybody knows Yahoo, and therefore there's like a bunch of inertia traffic that kind of keeps going to these sites, constantly, even if they're doing a terrible job. So he presents his turnaround plan, and the board basically says, here are the keys to the car, guys. Go, you run it yourselves, as a management team out of the Czech Republic. And so they've only been overseen like one public quarter as a public company, but they were adjusted EBITDA profitable for like the first time in years. And the thing is, if you look at this kind of slimmed down, smaller company and say, okay, what's a reasonable enterprise value to EBITDA multiple for a web company? Like that's not growing like crazy, but it's just, it's churning out like eBay style kind of profit.
is that 10? I'm making it up.
10x.
Yeah.
Yeah. 20x is is not unusual for what you see. Enterprise value to EBITDA, and so if you look at what's a normalized kind of EBITDA level for, they're doing like 130 million revenue a quarter. They should be doing like 15-20% in profits every quarter. My math says this should be $100 stock, in a year or two.
Where is it
versus like $12 or probably is up today.
I say it's a good business. I don't know if it's a good public business.
It's just a forgotten about business that's just been ignored, and 30. I don't know. It depends on who you look at. 38% of the float is short, and so everyone's gotten in the kind of fat and lazy habit of like shorting this thing, think it's going out of business.
So how does this appear on your screen?
So it's one of these names that pops out of the 300 that pops up back in May. It says that, hey, something just happened, and we're detecting some. Stock started moving up again at $3
alpha extraction,
and it says you might want to take a look at this. And this is when I find out about the Czech Republic and all this stuff that's going on at this company. This is kind of interesting.
Anything else outside of the usual suspects that's popping up that's interesting?
There's a company called Taboola.
I know what this is. This is the shitty ads.
Is that hummus?
It was
yes, that's right. That's right, Michael.
A delicious Israeli company that basically does kind of the outsourced ads on the rest of the open web besides Google and
Taboola
Facebook.
is, when you're reading a Business Insider article and you spent way too much time and you get really far down the page.
Yeah.
Once you get down further than the comments, and even down further
past
than
the comments,
there'll be this block with 4 ads in one.
Yeah.
And one of them will have cleavage.
Yeah.
And am I lying?
No.
Okay. One of them will have like just tremendous anatomy. The second one will have something really gory. The third one will just be like a animated question mark. Each of those units is a Taboola ad unit. And they are
proud of those units.
No, but it's backfill to backfill, right? Like there's the affiliate ad network, and then there's Taboola, which is like, throw a little Taboola on there. We'll see what happens, right?
Yeah, but they also place like normal ads, and so the thing that's interesting about them is that they signed a deal with Yahoo in January of this year, basically to kind of take over placing ads.
That's
across
weird because the ads on Yahoo
network
are also reputable. Say more.
So, I've followed Yahoo, as for years and years, and always been interested in them and as activist play. They're private still. They were sold by Verizon.
Who owns it? Apollo owns it or something?
Apollo bought it.
Crazy.
And so Apollo put this guy who I know, Jim Lanzone, in charge of it. And Jim is a kind of a seasoned web executive who he got to start running Ask Jeeves. Remember that the search engine?
So he brought in Taboola onto Yahoo.
So he signs
pages.
this deal with Taboola. He's doing a bunch of other things. We'll find out when they IPO one day, but apparently they're doing really, really well. They'll probably come out with like some kind of normalized valuation and then go up from there. But investing in Taboola is kind of
Yahoo is going to IPO.
Well, they will for sure, and at some point because Apollo's.
Can we get Marissa Mayer back? No,
I don't think she'll be ringing the bell.
Okay,
downtown.
She's not ringing the bell. Okay.
Oh shit!
But Taboola did this deal with Yahoo, and so Yahoo took a piece of Taboola into equity, and so they signed this deal, and it can be massive. But the thing is, it didn't get implemented. Like they didn't, in January when you sign the deal, you don't start seeing the results in the financials.
Is it a $3 stock?
So it's a $3 stock.
Okay.
But basically everything got turned on last month in October. So we're going to start with the next earnings report from them to actually see
Eric, why
the financial
is it Taboola
impact.
Limited? Is it European or British?
Israel.
So let me ask you guys this: Did fintech just bottom? So Affirm was up 20% today. PayPal is up 7% today. Square just raised guidance. They're up 16% in the after hours. What do we think?
You like any of these?
What
names?
do we think?
I think it's interesting. They got clobbered on the way down. I mean, just a few days ago, like at the beginning of this week, Square was within $1 of its like March 2020 lows. So they'd been hammered.
There's nobody left to sell these stocks, though, right?
It's not going to take much for them to get going. Like I said, it's up 60% in the after hours.
Yeah. They bought Afterpay. Remember them a couple of years ago? Buy
So
now,
I think-
pay later, and
I
for
saw a
$29
stat.
billion, and now they're
Their market cap is smaller than what they paid for that.
right.
Unbelievable.
Exactly. So have they bottomed? Yeah, I think so. And I think there will be some winners in there for sure. And I think Affirm is interesting.
They just announced a deal with Amazon today. Small businesses are going to be able to buy now, pay later. People might scoff at that. I love it.
Can we do this before we wrap up? Did you see any of this stuff with Zillow and Redfin?
See it. I own the stock.
Okay. These stocks all got hammered on a court decision. Did you see any of this?
Yeah.
What exactly happened? Do you know?
I don't know all the details of the court ruling. They were, basically they have this liability that the realtors were all price fixing.
Yeah.
So this happened in the Midwest. This happened in Kansas, in a Kansas courtroom. We don't have to have a long discussion about it. It seems like this is a big deal, only because I don't know enough to, there was a jury. They had 2 weeks of testimony from plaintiffs. The defendants were the National Association of Realtors, NAR, and a lot of the big real estate franchises. And they were basically accusing them of price fixing with the commission because home prices have gone up so much that 6% or whatever is really noticeable. It's like a big chunk of money. And the plaintiffs won. So it says they were ordered to pay $1.78 billion in damages to the sellers of more than 260,000 homes in Missouri, Kansas, and Illinois. So if you sold a home in those 3 states in the last few years, I guess, you are owed money by these realtors who were colluding and keeping commission rates high, which I'm sure will be appealed.
Right.
But they immediately whacked Redfin, Zillow, which I guess are highly reliant on commissions and realtors advertising there. So I don't know.
I don't own it. I think it's going to be interesting to see whether, where do these stocks trade in 5 days from now? Because was it really that specific court decision that drove them down?
They were already going down. You know what's too lot of stock? Open Door. $2.
They're reporting tonight.
Oh, do they?
Yeah.
Open Door reports tonight.
Yeah.
What are your thoughts?
Not a great model.
They got whacked in the same NAR ruling as well, which kind of makes less sense than Zillow because
weird.
They
don't have realtors.
they're trying to
buying and selling.
disintermediate the realtors, and so they're buying and selling the homes themselves. So I think I think that eventually this stock is going to be a winner. It's basically traded, and Zillow to some extent and Redfin have sort of traded with housing in general and kind of the home builders.
What's one stock that you gave up on this year? What's something that just you decided it's not going to work?
Open Door definitely.
Okay.
I kind of let go of the rope, and I'd say in the spring of this year.
Okay.
there were too many disappointments with it. There have been other stocks like that. Zoom was one that I talked about.
I just bought Zoom back.
You did?
Yeah.
There's a lot of stocks like Zoom
I'm so bullish on Zoom.
where people just have stopped caring.
Hang on. I can't let
know,
that
but
go.
I like that.
That is good. You're right.
How are you? Why are you
that
so
is the
bullish on
sign of a
Zoom?
bottom.
Because Zoom has gradually transformed itself into an enterprise software company for businesses. And they're using video tools as just the advertisement to get you in the door. We fired RingCentral and adopted Zoom phones. Zoom eventually will probably take over Slack from us. They are building all of these really critical enterprise tools for businesses, and nobody gives a shit.
The stock.
And what's the stock? Is the stock still like 69 or
Nobody
something?
cares.
Look.
It's in the 60s.
Yeah, which is where it was in 2019.
It kind of
when the
stopped going
IPO.
down.
The stock could go to $120 and still be cheap. It's
Yeah.
16 times earnings.
Right.
Nobody cares
Yeah.
because they still think it's a fucking work from home stock.
Well, yeah,
They don't believe the earnings.
Think of how much bigger it is today versus when the IPO in 2019.
They have it's a $16 billion market cap or something like that.
Mm-hmm.
They're selling software to businesses. It's not work from home at all, but they still have this video that acts as the front end. It's how most people know the name Zoom.
Yeah.
But that's not really going to be how they make most of their money. That'll be one tool of 10 that they're trying to be, I don't want to say Salesforce, that would be the wrong comp. But they're trying and succeeding to get enterprise customers.
Their revenue is not growing at all.
Yeah, I mean that's
But it's not.
that's my concern is
at all.
It's
what is the
never
growth
gonna
story,
grow.
Josh?
It's never going to grow the way
So
it
what are
grew
you
in
buying?
2020.
But it's not growing at all.
It's
But I'm not paying for it.
But to get it to go to 120, there's got to be a bit of growth. Like you got to have the phones thing play
Well,
out.
Josh is right. If they give any good news, if they raise guidance, it'll be up 20% in a day.
No, yeah. And there are a lot of stocks like Zoom these days. And hopefully, like, it's 2.5 years into this frigging bear market for
Let me put it this way.
non-Max
I
7
think my
stocks.
risk in Zoom is that they don't find growth and the stock just languishes. But it's not 50 times, like it's not a company losing money. It's a profitable company with cash flows. And I don't think like a mid to high teens PE ratio is a huge risk. I think they have the chance to figure it out. And if they do, you won't be able to buy it. So look, a lot of these tech transformations don't work. Like BlackBerry did not work.
No.
They tried to be a cybersecurity company, and it didn't work. All right, did you have fun on the show today?
I did.
You did? All right, we could do another. I could do another.
I don't know about Zoom. I think I'm going to stick with my Groupon.
All right, you'll come back next. You'll come back next.
We'll do a compare
week.
and contrast.
We'll compare Groupon with
Groupon
Zoom.
Zoom.
All right, fair enough. We're gonna end the show with favorites. Eric, what are you into these days? What are you watching? What
I
are you
thought the
listening
most
to?
interesting thing in the last week was Stan Druckenmiller. There was like a leaked video of him talking to Paul Tudor Jones at Robinhood. That was interesting, where he sort of took shots at Yellen. Then he did a CNBC interview the other day in the morning.
Druck is hot right now.
Of all the old guys who go on TV and get treated like gods,
That's your guy?
I think like he's the conscience of sometimes I get a little carried away with myself. I get a little bullish. I get a little Tom Lee-ish. And when you hear Stan kind of chiding the market, like I think you gotta heed.
He always chides the market.
Yeah.
Yeah, he ain't coming on to tell you 72 and sunny today. He's not coming on like he's not coming on to tell you that things are fine.
No.
And he might,
But he's interesting.
he's interesting.
Versus a lot of these guys.
He's earned the attention and the respect of the street for sure.
Yeah.
And not that many guys out there like that. So it doesn't mean he's right all the time, but I agree with you. What about you? You got a favorite for me?
I don't.
Really?
I was
Nothing?
dry this week.
How was Halloween this week?
It's good.
Yeah? How'd you do, candy-wise? To clean up?
It's good.
Yeah?
Got some Butterfingers. I like Butterfingers.
Is that your go-to?
No, I'm a simple man. I like Snickers and Reese's.
I went to Dave's house that night after Halloween. They were
Yeah.
sorting candy on. They got 3 kids.
Yeah.
They were sorting pounds of candy on the floor.
Yeah.
I said, you should sort it all right into the garbage can.
Yeah.
Nobody,
You know what we tried this year at my house was only buying the big candy bars. and
That's the
passing
baller
them.
move.
And
What do you mean? Like
you
regular
know
size?
when you were a kid and you go trick or treating and there'd be that one house
The
that
hero
was like
house.
giving like the huge
Heroes.
Baby Ruths and whatever.
Oh.
And like so we decided like this year we're going to try that. We're going to only buy these bars and like
And were kids high-fiving you?
you couldn't believe the reality.
You know who does that?
You could not believe their
Dude,
faces.
you know who does that in America? Bleep this out, Duncan. He's a hero
I
for doing
believe
that.
that.
Yeah.
Well, that's his business. He's the candy
And
man.
the other amazing thing is that we had the biggest thing that we handed out was a pack of Twizzlers.
Okay.
That was like I don't know 10 or 12 in it.
Yeah.
It was the biggest. It's bigger
The
than
movie
candy.
theater, like the movie theater size? Like the
Not that. Sort of
All right.
in between.
You know what's
kind of
interesting?
normal.
How
But
it's-
that's
go
what
finish.
kids wanted. They wanted the biggest. They didn't care there was Twizzlers.
You know what I want? Peanut butter Twix. That never makes its way into candy bags.
You know what I gave out? Solana. I did. I gave everyone a thumb drive. We didn't give out anything because we weren't home. We're no fun. I guess we're like the no fun people.
No,
now.
I left. You leave a bucket of candy and it's gone in
Yeah,
20
we did.
minutes.
We did that, but I don't even think we put anything good in there. So.
So actually, I've been slowing. I've lost momentum on House of Usher. Not really because I don't like the show.
It got confusing, right?
I'm on episode 4. I've just been busy. I think I don't know.
Okay.
Did you finish it?
No, I didn't finish it yet. I think I'm on 4 or 5.
Yeah.
But how many episodes are there? Did you watch this? The Fall of the House of Usher.
No. Heard you guys talk about it.
It's entertaining. I think it's worth checking out. I want to help some people out, save some time on podcasts as my favorite. So I'll tell you what to listen to, what not to. Charlie Munger on the Acquired podcast.
Great call.
Just listen to it. It's
That's
an
great.
hour.
Yeah.
Every interview, he's on the clock. He turns 100 next month. Every interview he gives, this could be the last one.
Right.
And he's still awesome.
Right.
So I highly recommend Charlie Munger on Acquired. You could skip Elon Musk on Joe Rogan. It's like pretty, unless you're like a super fan, it's kind of painful. There's nothing of substance in it really. And it's like at a certain point, it's like Rogan's like, so, hey man, what's your favorite color? Like at a certain point, it's like, why is this
Even if you're
conversation-
listening at 2x speed, like
Yeah, why
No, it's
is
interesting
what
though
am I
about the
doing
way
here?
Elon talks. He's like thoughtful in his delivery. He doesn't just speak. He like takes a beat or two.
Yeah, I don't know from that. From Long
Same.
Island. We just talk.
Yeah.
We just go.
We just talk and then immediately regret it.
I don't know
wait,
what all this
I
thought. I don't know what all who people have time for thoughtfulness.
It's kind of impressive.
There was one other that I listened to. What was it? Maybe another acquired Jensen Wang. Did you listen to that?
no.
Oh shit! This is right up your alley. So you know who those guys are?
No.
The Acquired podcast. They do like the greatest growth companies ever, and there's two guys. They'll each read 10 different books, and they'll have a conversation about what they learned. So they've done like LVMH famously. That's like one of the big. Anyway, they did 2 episodes on NVIDIA, and then they did a third. They got Jensen on, and Jensen gave them 2 hours, and this is like right up your alley. So on the flight back to Canada, this is what you want to do.
Wait, one last thing. So just talking about like stocks that are beaten up that nobody cares about. So Paramount, obviously, it's only in the after hours. Nobody owns Paramount. The stock's up 11%. I don't know what they said, but a lot of these beaten down names, like, doesn't take much to get them going.
Right at a certain point.
no more sellers.
There's nobody left to sell.
Right.
Do we have an Apple print?
Apple is
Should have just come out.
Apple is down less than 1%. All right, rally's over. Shut it down.
All right, Eric Jackson, ladies and gentlemen. Thank you so much. We had the best time with you as
Thank you,
always.
guys.
I want to tell people where they can
That was
learn more
fun.
about the fund is EMJ. Is that Eric Mahomes Jackson?
Mitchell.
All right. Where can they learn more about you and your fund and all the stuff that you're writing and working on? Give us some places to go.
At Eric Jackson on Twitter, emjcapital.ltd on the web.
Okay.
You can find me on TikTok,
taking
Instagram.
new clients these days, or where are we at?
Always talking.
Always
talking to
I
folks.
like that answer.
Yes.
All right. Thank you so much, Eric.
Thank you, guys.
Hey, great job this week, John, Duncan, Sean, Nicole, Rob. Thanks to the whole gang. You guys did a
116
great
in the
job.
books.
That's right. 116 in the books. Thanks to everyone for listening. We will see you next week. Take us out.